Welcome to PocketExperts.Solutions. This event is for educational purposes. The terms and conditions and the privacy policy apply as posted on the PocketExperts.Solutions website. Today, our guest expert is Lari Masten. Welcome, Lari.
Hi, Mark. How are you doing?
Good. Lari has a valuation practice and consulting practice that started in the mid-1990s. She is the founder and managing director of Masten Valuation and National Business Advisors. These entities offer comprehensive business valuation, forensic accounting, fraud investigations, and litigation support services for business transactions, shareholder disputes, damages, lost profits, marital dissolutions, financial record reconstruction, financial reporting, and tax compliance. She has been performing these services for businesses across the United States in a variety of industries, including exploration and production of natural resources, manufacturing and distribution processes, life sciences, personal professional services, construction, real estate development and management, and agricultural related service sectors. Lari has extensive experience in valuation and business consulting, as well as respected by her peers throughout the valuation professional community. She's earned a Master's of Science in Accounting degree from Texas Tech University and is a licensed CPA. She holds the following 6 specialized designations: Accredited in Business Valuations, ABV, and Certified in Financial Forensics, CFF, through the American Institute of Certified Public Accountants, Certified Valuation Analyst, CVA, and Master Analyst in Financial Forensics, MAFF, from the National Associations of Certified Valuators and Analysts, Certified Patent Valuation Analyst, CPVA, by the Business Development Academy, and Accredited in Business Appraisal Review, ABAR, through the Institute of Business Appraisers. Today, our meeting is going to talk about rules of thumb, what you need to know before you start using them. Lari, do you have any opening comments?
Yeah, hi. Thank you, Mark. I appreciate that. Yeah, sure. So rules of thumb are, to be real candid, shortcuts. Always a shortcut. And these shortcuts can be guidelines that can help make some of your complicated decisions a little bit easier. I mean, just in general. But what to keep in mind is that rules of thumb, and then we're going to talk about rules of thumb for businesses in general, are really just guidance, and it's guidance based on experience or practice from people who are involved in helping transition businesses. And so it's not based on theory. So it's really important to keep in mind that they're guidelines, and that's why they call them rules of thumb, and that it's not a replacement for having a full valuation done for a business.
Sure. Let's start with our first question, Lari. What is a rule of thumb?
Okay, so we kind of just talked about that a little bit, but to get a little bit more deep into rules of thumb for businesses and how you value businesses, you know, a rule of thumb that we have is for valuing a business is based on the experience that brokers, CPAs, valuation analysts, business owners, buyers, and sellers have experienced over the years of selling businesses. And there's some really common rules of thumb that are widely used, well known. And when it comes to your business, and you know you've spent years building it, growing it, maintaining it, you want to ensure that when you sell it, that you're selling it at the right price, a fair price, and you don't want to leave anything on the table. Well, a rule of thumb is something that you can use to, you know, if somebody offers you a dollar amount for your business, you can look to rules of thumb to kind of give an idea of whether they're too high, too low, maybe your expectations are too high. But that rule of thumb is simply a measure of valuing a business that's just mathematical. Mark, you take a rule of thumb, you say it's 5 times, and it's 5 times something, let's say cash flow, and you take the rule of thumb 5 times whatever your cash flow is that you think is consistent, come up with a number, and that would be an indicated value under the rule of thumb. So the rule of thumb serves to help quickly make some complicated, very complicated analysis kind of come to light. Does that make sense?
Yeah. Should I use a rule of thumb to value my business?
Well, okay, yeah. So this is where you have to kind of be a little bit careful. And yet you can use a rule of thumb to get an idea of the value of the business, but not maybe to directly value the business as just as applied and think, okay, this is the value of my business. Now, that sounds kind of complicated. Um, when you're thinking about selling your business and you're thinking about how much is somebody else going to pay me to get my business, um, you probably should have in the back of your mind some idea of what the value is before you go out there and try to find a buyer. There's different ways of finding buyers, different ways of selling your business, and that's kind of outside of the scope of our discussion today. But when it comes back to the question, should I use a rule of thumb to value my business? I just want to say it's a good starting point, but you have to be really careful. In the valuation world, people get paid thousands and thousands of dollars to value businesses on a regular basis for different purposes. And so one thing that you need to be clear about when you're looking at trying to find the value of business, trying to find rules of thumb, understanding what they mean, is what is my goal? What is my purpose? Why do I need to value the business? So if I'm valuing the business to sell it, I'm probably going to have a different number than if I'm valuing the business because I'm going to have a partner buy in with me. So that rule of thumb to value the business if you're going to sell it is pretty reasonable, because that's kind of where the rules of thumb metrics come from, is from that M&A market, from buyers and sellers. So if you need to value the business and you're in this discussion with us, but you're not intending to sell it, I'd be real careful of using a rule of thumb, because even though they seem very simple on the face of it, it's easy to apply 5 times something. Why should somebody pay me thousands of dollars to value the business, right? There's a lot that goes into it. So if you're selling the business, using a rule of thumb is probably not going to be the primary way that you value the business, but it's certainly going to be a way that you might be able to understand the value that somebody else is proposing. Or if you're paying someone to value the business, if you paid someone in the past to value it, might be a good way to measure whether or not they're on the right track.
Larry, it's going to be kind of fun when we get a couple questions from now and we talk about how the rules of thumbs are developed. I think then the member or the user is going to understand that answer to that question a little bit more in depth. Because
Yes.
it does seem like, well, why shouldn't I use a 5 times multiple? How easy is it? When we talk a little bit about in depth on how they're developed and how they're used and what they mean, then I think you'll have a better understanding about this particular question's answer.
Yes.
What do I need to know about the meaning of a rule of thumb?
Okay, so first thing you need to know is that, behind the meaning of it is, what is the value that you're looking for, and the value to whom? So what you need to know about the meaning of a rule of thumb is what it implies. And what rules of thumb don't tell you is where their value is being derived from. So if you're looking at the value to you, the value of your business to yourself versus the value of your business to someone else, that makes a difference in the meaning of the rule of thumb, how it's applied, any adjustments that you need to make once you do that simple 5 times cash flow, math. Then you have to say, well, am I trying to figure out value to myself, value to someone else to sell it, value to, a partner that I want to have come in? So that the rules of thumb out that you see floating out there, and everybody who's with us today can Google, rules of thumb for whatever kind of business that they have, and probably come up with a variety of rules of thumb, but they're going to see really big ranges, right? And the reason why, and it goes back to this question, what's the meaning of the rule of thumb, is that all of those rules of thumb out there are aggregated based on different purposes. So some of those are when people are trying to sell their business, here's a rule of thumb, right? But you see a big range because somebody might be calculating rules of thumb from a variety of different transactions or a variety of different values that are based on different purposes. So you see this wide range, 3 to 5 times earnings, 3 to 5 times cash flow. Well, Mark, if you have I don't know, $500,000 in cash flow, the difference between 3 to 5 times cash flow is a lot of money, right? So the first thing you need to really know about the meaning of the rule of thumb is behind it, it's just a bunch of experience and transactions that may not all be similar to what you need. And that's why there's a big range behind them.
We'll also talk about how they're developed. We have the meeting, we have an understanding that if I want to use a multiple, I multiply that multiple by the same matrix that I have in my company, and then I can extend a value. That's basically what the rule of thumb is doing, right? 5 times something, 5 times sales, 5 times EBITDA, 5 times EBIT, whatever that matrix is that you're utilizing, right? You can convey a transaction into your particular value. But how they develop that is critical, Lari, and how you said that they developed the database is critical. Because aren't they basically averages? And if you take a look at an average, then you have to ask yourself, is my company average?
Exactly. And that's some of the things that we're going to be discussing today as we go through the different types of multiples is, the basis that they're on. Let me give you a real quick example. And maybe the example would be best under our next question, the how the rules of thumb are developed.
This is really the meat of the whole series, I think, because once you understand this, it's going to lay out not only a lot more clarity from the previous questions, but it's going to set up the rest of the questionnaire. So let's do a little bit of in-depth here on how they're developed, and let's talk a little bit about what this really means. You started by telling us that there are a lot of different types of transactions, right? But there's also the transactions in and of themselves may not have recorded the entire transaction, correct? Maybe they have, X number of dollars. Let's say I sold my company for $500,000. And of that $500,000, I got a consulting contract for another $200,000 that's going to come in for the next 3 years after that. The entire package of what it was sold might have been $700,000, correct? But the multiples are going to be used using the $500,000 because that's what the true transaction price was. The consulting was something different. And then if you're going to buy, you have proceeds versus actually sale price, right? So let's say, for example, I'm going to sell my assets for $1 million. Well, the transaction might be you're going to sell those assets for $1 million, but let's say I have, $800,000 worth of debt on the books that they didn't buy. So I receive $1 million for the sales price, but my proceeds are only $200,000 net because I have to then pay off the $800,000 in debt. So the difference between sales price and actually proceeds is a different issue, right?
It is, and probably the best way to give a good example of that, Mark, because that sounds fairly complicated. The best example I can give is most people have bought and sold a house or bought and sold a car before. And so what the concept that you and I are discussing right now is the difference between equity and invested capital. And the way I can illustrate that is to say, so if I'm selling my house, and we'll go the $500,000, you put that out there. So let's say I'm going to sell my house for $500,000. I've owned my house for 10 years, and I've paid down the mortgage over that period of time. Let's say my mortgage is down to I only owe $200,000 more on the mortgage. So when I sell my house for $500,000, I don't get the $500,000, right? I have to pay off that $200,000 mortgage. So my proceeds, what I get is the $300,000. So the difference between those two is the difference between what you see in businesses, equity versus invested capital. Equity is what's the value to me? The value of my house, the equity that I have in my house is the $300,000. I could sell it to someone else for $500,000. And when we're talking about rules of thumb, that distinction is very important, and that's why in our previous discussion of the meaning of rules of thumb, that's why you see this range, because sometimes rules of thumb are aggregated and they're based on that $500,000 amount, what I sold it to someone else for, and sometimes they include data related to the $300,000, my equity piece, and that's where you get that range. So when you're thinking about rules of thumb, what you need to know about them, how they're developed, the basis for them comes from a variety of different companies that have been sold, but the people who put that information out aren't always focused on, is it the $500,000 amount, the price, or is it the proceeds, the $300,000, right? So
Right.
as experts, when we're pricing companies and we're looking at valuing companies, we have a good idea of how those rules of thumb are developed. But I previously mentioned, anyone listening to us today and talking with us can go out and look on the internet and Google for rules of thumb for their types of business. Now, as an evaluation expert, we look at these and those rules of thumb have been developed based on experience, as I mentioned, buying and selling businesses, assisting with buying and selling businesses. So I can pick up a rule of thumb as an expert in valuing businesses, look at it, understand what's going on with it, and where a specific company might lie within that range, because I know how that price that was sold has been converted into that rule of thumb. And when the layperson is out there who doesn't have that same level of experience finds those rules of thumb, it can be pretty dangerous to just say, oh, well, it's 5 times earnings or 1 times revenue. It's very easy. Why would I pay someone to do anything like value it if I can do this myself? You can do that, but it's kind of dangerous because, as you mentioned, there are services out there that aggregate data, and they'll take that price, the $500,000 that they have, and they'll divide it by, something like the sales of that business or the net cash flow of that business. The problem becomes when that rule of thumb is being developed, price is usually not, too hard to figure out. If somebody says, well, I sold the business for $500,000, then that's my starting point, right? Price. Where it gets complicated is, all right, what was your cash flow? Now, if you ask the business owner, they're probably going to say a different cash flow number than what the buyer thinks the cash flow is, versus what the tax accountant who's been preparing the tax returns for the business for years thinks cash flow is, versus a regular accountant who might be doing financial statements. They might have a different idea of what cash flow is. So it gets, how they're developed, it gets a little complicated. And so you need, kind of broader question, what do you need to know about rules of thumb, is you have to be careful about who created and developed the rule of thumb first. You need to know where their viewpoint is, what's their perspective, what's their role in life, right? Basically, because that's going to then define how they view these transactions. Price is usually not something that people dicker about too much, but what that measure is that it's applied to, whether it's cash flow or sales or some other metric, assets, that's where it gets a little complicated.
Right. The best way to use a rule of thumb, and Larry, you can chime in on this, is really as a sanity check. So when you have that 3 to 5 times EBITDA or whatever, you actually do a detailed analysis on the actual company that you're going to value. And then based on whatever the detailed analysis determines, gives you a price. That price then is compared to the rule of thumb. And if it fits in between that 3 to 5, you feel pretty comfortable about that, right? Because it's
Right.
within that range. But it's not the multiple driving the value, it's the detailed analysis driving the value, thereby checked by the rule of thumb.
Exactly. And so that's how evaluators look at rules of thumb differently than business owners or anyone else. And so business owners really need to know, yes, exactly right. Rules of thumb are kind of a sanity check, but they can be a sanity check, and we have one of our questions is, how do you use a rule of thumb? And so we'll talk a little bit more about those sanity checks when we get to that point.
Let me give you a little bit of an example that always comes into my mind that maybe clarifies some of this point. You have 2 identical companies, Larry, and both companies have identical sales. let's say the sales are $1 million for both companies. But in company A, we have a very controlled business owner who loves to do everything himself and make sure that everything is perfect based on his own specs. They never really put a lot of CapEx back into the repurchasing of equipment, so their equipment is pretty much dated. It's 15, 20, 30 years old, and the technology is not quite up to date. But it produces the same results as the second company from a cash flow position. But the second company has a complete team of experts that all have their own departments that run everything efficiently. So if the owner's not there, it doesn't matter. It runs like a clock. They have brand new equipment because they have put in a lot of money back into their equipment, and they updated it based on technology over the years. And as a result of that, there was less distributions to the actual owner, but yet then they had the ability to reinvest that money into a better look. Both identical bottom lines, both cash flows are the same, both sales are the same, but the composure of each company is completely different. Would you use the same multiple, Lari, to value both of those companies?
Well, from a valuation standpoint, no. I mean, it depends, on, just like you said, the structure of the business, how we define, sales versus revenue. But in general, that company that is more efficient, they have higher focus on technology, they have, really put in the time and effort in the past to make sure that the company is not super reliant on one person, the business owner. That one should be on the upper end of the scale of my range of rules of thumb, because there's more value there. There's more, from a buyer's perspective, I'm buying into that system that's already in place. I'm buying into that setup of the better use of technology, of the higher performing assets, the newer assets that they've been replacing over the years. And so to me as a buyer, that business, even though the cash flows might be exactly the same, that business is going to have more value from my perspective because there's less I have to do to make it work better, right? And the business that the one business owner has been doing everything, they haven't been replacing equipment, they're not keeping up with technology. If I buy into that, it's going to be a lot harder for me to get it to the place that I want it to be. And I hate to kind of go back to this, but it's a great way to kind of, firm it up. Is it's just like that house we were talking about. When you're buying houses and you're looking at the prospects of, do I want to buy a house that's new? Brand new build, I'm certainly not going to have to be replacing anything like the appliances or doing the roof, making sure the electrical work, because it's all part of my probably under a 1-year warranty. So I know peace of mind when I go in, it's going to work, it's going to work well, and if it doesn't, I have some recourse with the builder. That house has a different value prospect to me as a buyer versus a house that's 40 years old. They replaced the HVAC system 10 years ago, so it's still working now under inspection, but maybe it's not going to be working next year or 6 months from now, right? So that's a great question that you asked on the difference in the businesses and the cash flow and how they're operating, because to me as a buyer, one is definitely going to have higher value over the other. And from the rules of thumb, that's one way to place your business within that range of rules of thumb. Are you the house that's maybe just a couple of years old, a newer build, but still, going to maintain integrity for a while for a buyer, or are you the business that's being sold that needs some work on it, right? Are you a fixer-upper, or are you a let's walk in and just put it the furniture kind of business?
Right. So ultimately, the details are what's dictating that range, not necessarily just the fact that we blindly take a 5 times EBITDA multiple.
Exactly.
Larry, there was one other thing that was really intriguing to me. The multiples really come from the private equity groups a lot of times, right? And as they do transactions, I talked to some of the private equity groups, and it was funny because the 5-time multiple you hear comes out a lot. And you always hear that the 5 times EBITDA multiple is the number one for multiple that's used by the private equity guys. And when I talked to the private equity group, I asked them about that. And he says, Mark, we do all the detail analysis that everybody else does. The reasons that our multiples are always 5x is because those are the transactions that we accepted that fit the box in which a 5x multiple would be acceptable. What you don't see is all the detail analysis and all of the other transactions that were rejected that didn't fit the 5x multiple, right? There would have been 7x or 2x, depending on all the other companies. They've chosen to create this company with the attributes of a 5x multiple. And now the question is, does your company fit inside their box, right? Because if it doesn't, it's no longer that 5x multiple. So be careful on how you use them. Any comments?
With that, it's really good to keep in mind. That's a great example. It's really good to keep in mind that what that ultimately means is that not every business can be sold, because not every business is attractive to buyers. And part of what you need to pay attention to when you're looking at rules of thumb and where you might be on that range is who's my most likely buyer. So if I'm looking at a private equity group as my most likely buyer versus an individual who just wants to buy my business and run it, then that's going to give me different guidance on what rules of thumb to use, how to apply them, and where I might fall on that range.
Let's take a look now at our next question. What are the different types of rules of thumb for valuing businesses?
Okay, so there's many different types of rules of thumb, and honestly, Mark, you can create a rule of thumb off of any measure that you can come up with that you think has value in a business. So, experts look at some specific rules of thumb on a regular basis, and the reason why we look at these on a regular basis, and there's probably 4 or 5 of them that are most commonly used, is that our experience tells us that these are the types of measures of the business that have the most meaning when you're buying and selling businesses and the most meaning to value. So the different types of rules of thumb that you have can be like a sales multiple. So price to sales. That just means, somebody says, oh, I have an accounting firm. I want to sell my accounting firm. How much should I be looking for it? A very common rule of thumb that is widely used and acknowledged is 1 times revenue. And it might be 0.9 or 1.1. You might move up and down off of that a little bit depending on the mix of the accounting firm. Do they have a consulting arm, or do they have some high wealth clients or something like that? But in general, that's a good rule of thumb, right? And that's based on revenue. So when I think about running a business, I think, well, revenue is important, but what about all the costs that it takes me to generate that revenue? Well, when you're talking about an accounting firm and that rule of thumb, the reason why the price to sales is the most meaningful is that you don't have a lot of what most people think of as cost of goods sold, because you have professionals that work for you. You hire bookkeepers and CPAs to prepare tax returns and financial statements and to do consulting work. It's not like you're buying a bunch of things to create the product. You're just buying professionals. So you have payroll, but that's about it. So that specific rule of thumb, that type of rule of thumb, is a good rule of thumb when you have a professional services or business services type of company. So accounting firms, law firms, those type of things, that rule of thumb is out there. And one of the things to know about the different types of rule of thumb, and we'll get into the other different types here in a minute, is some rules of thumb make better sense in certain types of businesses. So you have professional services, personal services, like a florist shop or a hair salon or something, versus a business that generates a product where there is a lot of analysis that you need to do on what's the cost of creating the product. It might be creating food because you're going to sell it. It might be creating actual tangible products that people buy. Those types of businesses typically have different multiples that are not a multiple of revenue, because it's real important to know what's the cost structure to get the cupcakes made before I sell them, right? If I'm a bakery. So a type of rule of thumb for that second type of business is usually going to be somewhere that involves an assessment of expenses. So not a sales multiple, but maybe what we would call an earnings multiple. So big range, big broad picture types of multiples. We have sales multiples, we have earnings multiples. And those earnings multiples you typically see when you have a business that requires a lot of expense or allocation of expenses before you can produce something that can be sold. So an earnings multiple would be like earnings before interest, taxes, depreciation, amortization. We call that's an acronym that we call EBITDA quite a bit, and we're going to talk about that here in a few minutes. That what those different acronyms are, what they stand for. But those earnings multiples could be an EBITDA multiple, an EBIT, earnings before interest and taxes, or it could be discretionary earnings, and that basically is net cash flow at the end of the day. So the different types of rules of thumb exist because you need different rules of thumb to value different types of businesses. Right. So you have professional services businesses, you have something that has very low cost to get something out there, you have technology businesses, those type of things. The value prospect of them are different than those that require a lot of costs that go into the product.
And Larry, it's important to know, I love your accounting example. Let me kind of expand on that for a minute, if you don't mind. We have an accounting firm, right? And let's say that we have very complicated type of clientele, and we have audit mix in addition to compilation, in addition to different taxes, but we need really high level consultants and accountants because of the complexity of the client mix. And then you have another accounting firm that has a lot of small, closely held companies that are not very complicated. And there's a lot of them. Now you have diversification of risk in the mere fact that you have a lot of clients. So if you lose one client or two clients, it's not really going to matter that much. But if you have a concentration of clients where maybe 5 or 6 of your major clients add up to 60–70% of your business, ultimately at the end of the day, that's a big deal and it's additional risk. So you have different attributes accordingly. How does the rule of thumb actually acknowledge those different attributes? The answer is it doesn't, right? A rule of thumb is nothing more than a transaction that took place somewhere, and they divide that measurement into that particular sales price to be able to convert that value into something similar to your own. So for example, if the company sells for $1 million, then that's a sales price that took place from the negotiations of all of these different attributes that took place, right? Whether I have a concentrated amount of clientele, whether I don't, whatever happened, that discussion took place for that transaction to happen, and now it's $1 million. So somebody decided to say, well, if I know it was sales was $1 million, right? And I had, let's say, $200,000 worth of revenue, I have a 5 times sales, right? Well, ultimately, that 5 times sales just happens to be the amount of sales for that particular company divided into the sales price. So if my company was similar to that company, then in retrospect, I could then take my sales, multiply that by 5, and come up with the value, right? And all you're doing is transferring the value through that measurement into your own deal. Well, that only works if you have the identical type of company with the same attributes that the original one sold for $1 million. Let's say we go to the other company with less risk, with a lot more companies, a lot more different clients, and let's say that one sold for, I don't know, let's call it $1.2 million because it was worth $1.2 million because it was a much more diversified type of client base and it didn't need as many high-end consultants, so they're much more replaceable, right? Well, that risk was definitely less. So now that sells for $1.2 million. If we had the same $200,000, then my multiple changes, right? So ultimately, it's just conveying the amount of the sale transaction that was done based on a detailed set of facts and circumstances by some measurement. And then the secret is to match up your company to the company of which was sold. And if you can do that, you'll understand how that's a good sanity check for what you have. The danger is if you compare your company, which may have been the company that had the high end of the experts that were needed with the concentration, but your firm didn't look like that. It looked like the other company that had a lot of smaller companies with less risk. Which multiple are you going to use, right? And
Right,
that's
and you
where
have
some of
to
the
be,
issues come in. Go
you have
ahead,
to be
Larry.
careful because there's different types. There's the market approach basically is where these rules of thumb come from. And the market approach, you can look at individual transactions. So I could go in and find those old transactions and say, okay, this company had these attributes and this, this is why they were at the $1.2 million versus the $1 million. Rules of thumb do not give you all of the granular detail behind them. Rules of thumb are just aggregated and out there, and you have no idea what the basis of the company was. You don't know if that accounting firm had high, wealth clients and high, consulting that had high margins versus tax returns and a bunch of small companies, right? So the caveat to rules of thumb, and should you use them, kind of answering some of the questions that we're talking about today, goes back to rules of thumb were developed over time, over decades and decades of time, but you don't have all of that information. And again, I go back to that's why there's a range, and you need some help more likely than not to determine where on that range your company fits. So when someone's calculating a rule of thumb and aggregating all this information to say an accounting firm should be 1 times revenue, what you need to know is what did somebody else pay for the business, and what do you think is most important about that business from a sales perspective, from a value perspective? Is it cash flow? Is it sales? Is it their assets that they hold? You can answer these for your own business, but you don't know the answer behind the rule of thumb, right?
Right. And that's why I think that ultimately the answer is, and actually one of the reasons why the standards for the NACVA evaluation organization basically state that rules of thumb are not standalone methodologies because they're sanity checks, right? And I highly suggest that the members and the users use them as sanity checks and not necessarily as the driving force to do a transaction. All right, let's take a look at our next question. What is seller's discretionary earnings multiple?
Okay, so SDE, seller's discretionary earnings. So as we're talking about, multiples and rules of thumb, and we're talking about price to revenue, a price to seller's discretionary earnings is simply saying, what did somebody pay for that accounting firm? They paid $1.2 million. Well, how much at the end of the day did the owner of that accounting firm take home annually on a regular basis? So the cash flow, right? And then if you can identify a clear, number for the cash flow that is expected to be taken from that business every single year, and you know that the price was 1.2 million, then you can say, well, 1.2 million divided by what that annual cash flows is, and you come up with a number, and maybe that was 3.7, right? So the seller's discretionary earnings multiple is just, that's how you would calculate it. Now, what does it stand for? That's the bigger question. Seller's discretionary earnings is not clearly defined by anyone, to be honest, Mark. At the end of the day, some people think that seller's discretionary earnings, which means you, the business owner, it's net income before you actually pay your own compensation to yourself. So if you have your tax return and you look at the net income number, you start with that net income number and add back in your salary. Let's say you're paying yourself $85,000 a year. It's a good business. You're running it well. You're making good money off of it. So you take your net income. Let's say you have $100,000 net income. Add back first thing your owner's salary. So you're going to add back the $85,000 to that. So to that, you also then look at, well, over the course of the years, on average, are there any other expenses that the business has that another owner of that same business would not pay. And by, that's a nice way of saying sometimes, not always, but a lot of times, on our tax returns, we write off things that may not be 100% related to business operations. Let me give you an example. Let's say I own the business and I own the real estate. And in the business, I have 2 partners and myself. So there's 3 people that own that. But me individually, Lari Masten, I own the building. All right. What I'm probably going to have is a lease rent agreement between the business and then myself as owning the real estate. And I might negotiate with my other 2 partners on what that rent should be. Now, depending on how much I work in the business or they work in the business, whatever we decide a rent to the business should be might not be fair market value. It might not be what somebody else would pay for rent. But to my own business, maybe I'm going to give myself, me and my partners a break because they put in more work. So I'm going to have them pay a little bit less rent because I'm not there 40 hours a week and they are, right? So when we're looking at seller's discretionary earnings, one of these adjustments is how much of that rent is really for operations and how much of it is it too low? Should it be higher? Or is it too high? Should it be lower? If it's too high, that means that I can add back to my net income plus my salary, I can add back in some provision for that extra excess rent that's being paid that isn't normal, right? So the concept is I take net income, I add back my owner's compensation and any other discretionary, non-operating type of expenses, or maybe even income. Maybe I have an account that's accruing interest. I get interest on it, and so that interest income is really not part of the business. Or maybe I have non-recurring expenses. Maybe I, have just revamped my website and I spent $10,000 on, doing a new search engine optimization along with the website. In the year that I'm selling, if I had just done that, my cash flow probably should not be 10,000 less because that was a one-time thing. It's already in place and it's going to happen. It's going to work going forward. That's why I invested in it. So that seller's discretionary earnings, what is it? How it's calculated? The essence is really to see if someone else buys into the business and steps into the shoes of you, the business owner, how much cash flow do they expect to get on a regular basis? And then using that as a measure of value to the buyer, we then create this multiple and say, okay, if you buy my business, yes, we have net income, but there's non-cash charges in there. There's, non-recurring things in there, et cetera. We understand that that's going on. So net income is really not a good measure sometimes of value on an annual basis because there's all these other things in there. That seller's discretionary SDE, seller's discretionary earnings multiple, is a multiple that's used and designed to identify if you buy my business, we think to some reasonable degree every year, whether you call it rent, whether you call it compensation, whether you call it, insurance for the family when you don't cover insurance for anybody else, what's the benefit to the buyer at the end of the day and what can they actually expect? So what is seller's discretionary earnings? What is an SDE multiple? It's a multiple that's designed for small businesses, usually single owner businesses, to say, if you buy my business, this is what we think you can expect on a regular basis moving forward.
Okay, let's talk about EBITDA. What's an EBITDA multiple, Larry?
Okay, well, EBITDA is different. So the seller's SDE, seller's discretionary earnings, is a multiple that's designed to capture the value of cash flow, typically, as I mentioned, to a single shareholder, or maybe it's a husband and wife team. EBITDA is a multiple that's typically used on larger companies that you're probably going to have multiple owners in, multiple partners, multiple shareholders, bigger companies that require more than one person to really run it. So you need somebody who's maybe you don't have titles, but you have somebody who, runs the operations, and you have somebody else who's doing the finance, maybe you have somebody else who's getting customers. EBITDA itself is earnings before interest and taxes, depreciation, amortization. Now I'm going to go backwards. Depreciation, amortization, all they represent is an accounting timing difference between when you buy an asset, like let's say you have a business that does embroidery on t-shirts, so that you put people's company logos on t-shirts. When you go in and you buy the embroidery machine, you have all of this equipment set up, that the cost of that equipment you then take over a period of years from a tax and accounting perspective. That depreciation amortization that you get as a quote write-off on your taxes is not really something that you have to pay for every year, right? I don't have to buy a new machine to do the embroidering every year. I buy a good machine, I might pay $80,000 or $90,000 for a good setup, but then that's going to last me many years. I'll have maintenance, but it's going to last me a lot of years. So that EBITDA is trying to say, well, we acknowledge that you might have had that $90,000 piece of equipment that you bought 5 years ago. Your depreciation is just however you get to write it off, but that doesn't really give us a clear idea of the cost of having the equipment, maintaining it, and replacing it over time. So the EBITDA multiple is to say, well, how does a buyer view the value of this business, knowing that there's a certain level of cash flow that they're going to have to then pay their sales salary. They're also going to have to do things like buy equipment, replace equipment, etc. The interest in taxes part of that multiple is also removed because not all buyers and sellers have the same tax bracket. And like I'm going to go back to the house, Mark. When somebody buys my house for $500,000, maybe they're downsizing. Maybe they're moving from a bigger house into a smaller house, and they, in their own situation, have enough equity in their old house that they're not going to have to borrow any money at all. They're going to sell their house, take the proceeds, buy my house, and they might even have extra money left over. They're going to fully fund that, and they will have no loan moving forward. Say they're retiring, right? Downsizing. It's very common to see that. So the EBITDA multiple is designed to say, okay, we understand that maybe you have all the money to pay for this business and you won't borrow it. So why would we model into the estimated value a factor for paying interest expense when potentially a buyer's not going to have that? Taxes are the same thing. You're in different tax brackets. So the EBITDA multiple is designed to put some of those variables specific to buyers and sellers on equal footing. So if we can define a level or measure of benefit, cash flow, EBITDA, that is consistent across the board, maybe what that tells us is our multiple is a stronger multiple, more reliable, because as a buyer, I use an EBITDA multiple and I think, okay, I am going to buy this business for X based on this multiple, but I understand that that's before I have to pay taxes, it's before I have to replace equipment, it's before I have to, if I'm going to have to borrow money, before I pay interest on that. So that EBITDA multiple, that's kind of how it's calculated. What it's for is typically larger businesses, and what you need to understand about it is that it's before other actual costs. So the EBITDA multiple, when you apply that, you're looking at your EBITDA, that's not all the cash flow that I get at the end of the day net to me, like the seller's discretionary earnings cash flow. This is the cash flow that's available to do two things. One, to buy the business and pay myself reasonable salary. But two, also from that, I'm going to have extra cash flow every single year to pay for replacement of assets and for my interest expense. Does that make sense?
Yep. Yes, it does. Let's talk a little bit about EBIT. What is an EBIT multiple?
Okay, so EBIT, because we just spent a little bit of time on talking about EBITDA, this one's a little bit easier, right? So EBIT is just the design of it, the purpose for it is basically to say, hey, there's a difference between, there's kind of a middle road between the seller's discretionary earnings, net cash flow to somebody all the time in a smaller business, one or two shareholders, versus EBITDA. Let's find out the cash flow on a regular basis to a larger company that also that cash flow has to pay for what we call capital expenditures, replacing things, and taxes and interest. EBITDA says, well, maybe it's an asset intensive business, or maybe it's not, but the depreciation amortization is less of an issue to us. So you have to look at the type of business that you're potentially selling, and consider what goes into the value of that business. How often do I have to replace assets? So oftentimes as a valuator, I see most valuation analysts focusing in on that EBITDA multiple rather than EBIT, because they're generally valuing businesses that require a regular replacement of assets, or that their asset mix, furniture, fixture, and equipment, represents something different to different particular buyers.
Okay. Are the rules of thumb universal?
Okay, this is a great question. Now, we've talked about what they are, what they mean, how they're developed, the different types that we have. And so now, when we look at are they universal, I feel compelled, Mark, to say first off, a rule of thumb, what does it represent? It represents the value of the operating assets for a company. It represents the value or the price that someone's willing to pay for the tangible assets that are required to run the business, so furniture, fixtures, and equipment. And it represents the value that is associated with intangible assets like goodwill, name brand, location, etc. But it doesn't represent anything else, right? So that number that you arrive at when you have a rule of thumb, it's good to know what it represents, first off. So are they universal? And the answer is no. It's a quick conversation. And by that I mean the rule of thumb that we're talking about for accounting firms of 1 times revenue is not a rule of thumb that you would then turn around and use when you're valuing a company that is, say, a bakery. It's not going to be 1 times revenue. So that's what, the type of business and the audience that the business caters to. Is it professional services? Are they selling products? All of those things make a difference. So you can't just take, I'm going to go back, Mark, to your discussion that you had with the private equity groups. They're saying they're looking at a 5 times multiple, always. And I see that too. And it's typically, it doesn't matter what the type of business is. From the private equity group standpoint, they kind of look at a rule of thumb as universal because, just as you say, they vet the businesses that they consider, and they have certain box to put them in. They have a certain profile of a business. If it fits all those profile markers, then to them, that's worth 5 times EBITDA. But you cannot take rules of thumb for one business type or one industry and equally apply them across the board.
I agree. It's also pretty important for you to understand that all you're doing is finding a way to transfer value, right? So let's say that you have a sales price, and that price is $1 million for the sake of easy numbers, right? You have an EBITDA number, you have an EBIT number, you have a SDE number, and if you divide either one of those numbers into that sales price of $1 million, that's going to give you 3 different multiples, correct?
Right.
So if I have 3 different multiples, then all I really need to do is be able to calculate each one of those types of measurements within my company. I need to know what my seller's discretionary earnings are. I need to know what my EBITDA numbers are, and I need to know what my EBIT numbers are, right? So if I took those multiples that I found from the company that was sold based on those 3 measures, and then I looked at my 3 multiples that I have, or my 3 measurements, and I extend those multiples to those measurements, I then would somewhat equate another value, would I not, for my company?
Yes. Yes.
So all we're doing is transferring the value of one transaction to the value of mine through these series of multiples by taking the sales price, dividing it by the particular multiple as calculated to come up with a number, so many times that sales price, and ultimately take my extension of those numbers that I calculated in my business and multiply them by those multiples that would then generate the total sales price that my company would then be worth based on those attributes. That's as raw as I can think of from a multiple calculation. However, none of the other details are actually on the table because of the fact that it's an understanding when you're using a multiple that you have similar companies with similar attributes. Is that a first statement?
Yes. And one thing that I think is real important is that doesn't take into account things like geography, right?
Right.
So if you're looking at, you have a hair salon in Salina, Kansas, as compared to a hair salon in, downtown Manhattan, the location makes a difference, right? Because your clientele has, different levels of worth, different demands, different cost structures on rents, all of those things. And the rule of thumb doesn't account for that. So you have to have your own consideration. And that's why, honestly, rules of thumb are very dangerous. And that's why rules of thumb are not considered a standard, I'm using air quotes, but you can't see me, they're not a standard valuation method because of these very things that we're talking about.
Right. What adjustments do I need to make when using a rule of thumb?
Okay, so this is a great question. So when you're applying a rule of thumb, we've talked about a lot of the different ranges. We've talked about, when you have a higher performing, higher technology, newer company basically versus an older company that needs some work on it. When you're looking at the adjustments that you need to make if you do use a rule of thumb, there's a lot of considerations, all right? The first consideration is if you're out there and you have a rule of thumb and you're applying it, are you using it because you're going to sell the business to someone else? And if you are, I go back to the concept that what does a rule of thumb represent? The rule of thumb represents the value of the tangible assets necessary to run the business or provide the service or the product. So furniture, fixture, and equipment. It excludes real estate, but it also includes any goodwill or value associated with it. So what do you need to do to adjust that rule of thumb for your specific company? First, you have to step back and say, value to whom? Value to me or value to a seller? Okay. If you're looking at the value to a seller, you also have to understand that real estate is excluded typically from rules of thumb. And Mark, you and I in the past have talked, you have a great example, so I'm going to ask you to illustrate it just real quickly. But there are certain types of businesses where real estate is honestly a necessary component of the operations. Now, the example that you gave, and it was a great one, was about bowling alleys and about the tenant finish required. So most of the time, you're not just going to go rent a building and then create a bowling alley, right? In that rule of thumb for bowling alleys, the cost of the real estate's not there. So that's something that you have to make an adjustment for if you do own the building before you sell the bowling alley. Do you want to illustrate that real quickly?
Sure. Ultimately, it comes down to there was a time where one of the valuators actually valued the bowling alley, and the transaction data said that the real estate was not included in that transaction. And I actually called up the broker on those transactions, and I asked him if the real estate was in fact included with that, and he said absolutely. So ultimately, you have to make sure that you understand what's going on with the transaction and what is actually included in the transaction and what is not when they create the multiple. Now, one way of really understanding that is a bowling alley is a bowling alley, and the building really has no second purpose other than a bowling alley, right? So when you get to that particular location, it could be a bowling alley, it could be a factory, it could be something that's very specific to the organization and its needs. Odds are that when you're going to sell that business, the transaction is going to include access to that particular property and having that availability to that transaction with the appropriate real estate. Now, in and of themselves, you might have like a factory that doesn't necessarily want to buy that building, but will put an extension of a long-term lease on that building, right? To be able to make sure that they have access to that specific property's use for a long period of time. Now, that's completely different than a company that doesn't. Let me give you an example there, Larry. Bolinelli is pretty easy and obvious, right? But let's talk about a manufacturing company that needs to have a river to be able to transport its product. And it needs to have a building on the river that can then use that to put onto barges that can move things overseas. If you don't have access to a barge, you don't have access to a river location where you can put that information on, then you need to truck it through that particular scenario onto a bridge or a barge, and that could be miles and miles away. So ultimately, for the efficiency of the operation, that piece of property was critical. And the difference between having that property and not having that property was huge in the actual transaction of the entity for the value of the purchase price, right? So would you pay the same amount, even though you could physically operate that company anywhere from any location? The cash flows themselves would be considerably different with that manufacturing company if it wasn't on the river. And was that taken into consideration with the sales transaction? Did I answer your question, Larry?
Yes, and that's a great example of, and so, adjusting that multiple, let's get back to the question, how would I adjust that multiple, or what adjustments should I make? If I'm buying that manufacturing property or the manufacturing business, but the people who own the property don't want to sell the property, I need to go back in and say, well, it might be a 4.5 times EBITDA multiple in general, but if I'm going to have to now move to a different location, which, the cost of that might not be too big, but more important, I'm going to have to, hire people to truck things back and forth to the nearest, river to get onto a barge. I'm going to say, well, here's an indicated value based on the regular multiple, but I estimate that there's going to be additional cost involved. And so maybe I'm going to lower, I'm going to negotiate on the lower end of that multiple, because I know for a fact that I'm not going to have access to that exact real estate. I'm not going to have access to that exact setup where they've already got the barges in place and everything, the docking station, everything retrofitted. I'm going to have to do something different and also negotiate with, somebody else to then have access to their, slips so that the barge can get in and load everything, right?
Right.
So that's a great example of one of the ways, any adjustments that you might make. Now, before we end, I do want to mention, I said, you're selling to someone else, you have to understand what that rule of thumb includes. And I'll go back, that includes your furniture, fixtures, and equipment, not real estate. It includes goodwill, but nothing else. So if you're taking a rule of thumb, though, but you're using it to have somebody buy into part of your business, but not all of it, another consideration you need to have on that rule of thumb are other adjustments that are very unique to your specific company. Things like cash, receivables, inventory, other liabilities. Because if you're inviting somebody in to be part of your business, they're buying into the partnership. If you have a lot of debt right now, they're going to be buying into that debt. And honestly, Mark, I've counseled with a lot of companies who they say, oh, well, here's a rule of thumb. It's an accounting firm, whatever it is. It's a 5 times EBITDA or 1 times earnings. So if you're a partner, you want to buy in, then it's 1 times earnings times 50%. You can't do that because your specific company is going to have those unique aspects of the balance sheet. And once they buy in, once they're a shareholder, they're also buying into the liability of the business as well. So it's very dangerous to use rules of thumb. It's very dangerous to use them blindly. And there's a reason why rules of thumb are out there. There's a reason why there's a huge profession of people out there that make a living, an honest living, in valuing businesses, because there's a lot of danger in rules of thumb in general.
And Larry, it's really kind of penny wise and dollar foolish. If you want to insist on just saying, I'm going to use the rule of thumb because you think you're saving a few dollars, just be cautious about the conversation we just had and make sure that you understand that you could be on the high side or the low side of those transactions. And either way, it might go awry. You might overstate the value of that company, and guess what? Now you end up in a lawsuit because what you told them was going to happen didn't happen, and now the buyer is disappointed. Or vice versa, you could sell the company for considerably less than what it was actually worth. So, when Lari was talking about the example with the accounting firm, I even heard a wider range than that, but let's just take it at, 0.9 or 1.2, depending on if you have a better or worse entity. Even if you took it at 1, think of that for a minute and use that as a number of your sales. The number differential between 1 and even 1.2 is a sizable amount of money. Wouldn't you have peace of mind to get a valuation expert in that knows what they're talking about? They can put together some numbers for you for between $2,000 to $5,000 and give you a pretty good idea where you stand. Isn't that the best $2,000 to $5,000 you ever spent when you start talking about the sales price of your largest asset or one of your largest assets? Would you go to a broker and ask them to sell your portfolio without necessarily understanding what the gains would be or the losses would be or the complications of the tax issues would be? I think it's important for you to understand. What do you think, Larry? Do you agree?
Absolutely, absolutely. And that's why, hopefully what, a couple of the takeaways are, the rules of thumb represents, a good body of knowledge behind a bunch of people who know how to buy and sell that particular type of business. But you also have a lot of questions that you have to answer as far as what's actually being sold, what does the buyer actually think they're buying, is the real estate included or excluded, what these adjustments might be, and at the end of the day, is there someone who can say, here's the rule of thumb, here's what your company has, and they can assist you in measuring where on that scale of the rule your company might lie.
Well, thank you, Larry. If you've enjoyed today's event, feel free to explore other opportunities as presented by Lari and other members of our team on the PocketExperts.Solutions website. Thank you for spending time with us and enjoy your journey to achieving your goals.